The Beyond Meat Inc. (BYND) stock closed the last trading session at $1.39 per share, marking a significant plus 16.81% daily gain. The reality of Beyond Meat stock right now is not about a fundamental business turnaround, at least not yet, but rather a perfect alignment of extreme market mechanics, specifically a short squeeze setup coupled with low liquidity, that is causing a violent, whiplash-inducing bounce off multi-year lows. This massive swing is far from an endorsement of the company's underlying financial health, which is what most investors expect to be the driver of a move this size. The common narrative on the street, especially for those who follow the online investing community, is that Beyond Meat is a struggling meme stock whose better days are behind it, a thesis supported by consistent revenue decline and cash burn. The market expects every piece of news to be bad, which is why a delay in their Q3 earnings report, while generally negative, somehow created the kind of uncertainty that short sellers, who are betting on the price to fall further, could not tolerate, forcing them to cover their positions and thus creating this sharp, unexpected upward pressure on the price. This tension between the grim fundamental reality and the powerful, purely technical market spike is what makes Beyond Meat such a fascinating and dangerous stock to trade right now. The sheer trading volume during this recent spike confirms that this is primarily a technical and sentiment-driven event. When a stock's float, which is the number of shares available for public trading, is heavily shorted, any significant buying interest, whether from retail investors looking for a high-risk gamble or from larger traders testing the short position's conviction, can trigger a rapid escalation. In the past month alone, this stock has seen wild swings, dropping as much as 46% before this most recent surge, highlighting the profound volatility. For those relying on online investing platforms like Robinhood, the low share price and high volatility make it an appealing target for speculative trading, driven by the chance of a short-term multi-bagger return, completely disregarding the bleak long-term prognosis. We're seeing institutional investors playing both sides here, while some, like State Street and BlackRock, have increased their holdings, likely in a passive capacity or to execute complex option strategies. A larger number of institutions have been reducing their positions, reflecting the underlying lack of confidence in the business model. This divergence in institutional activity, 71 firms adding shares versus 91 decreasing their positions in the most recent reported quarter, tells a story of profound disagreement on the stock's future, or simply opportunistic trading around the extreme volatility. The average daily volume has been sky-high, further confirming that this is an active trading arena, not a fundamental investing one. This environment of extremes is why individual investors need to approach this kind of move with extreme caution. It's a trader's market, not an intelligent portfolio building scenario. The deep-seated challenge for the Beyond Meat stock is that the reality of their business fundamentals is still wrestling with the expectation of a category rebound. The company, which is a leader in plant-based meat substitutes, has not reported a profitable quarter since its IPO. Their core business, which involves developing, manufacturing, and selling plant-based protein products designed to look, cook, and satisfy like traditional animal meat, faces headwinds on two fronts: market demand and operational costs. On the market side, the initial euphoria for the plant-based category has cooled dramatically. CEO Ethan Brown himself has cited ongoing softness in the plant-based meat category, a candid admission that goes directly against the initial public expectation that this product would smoothly transition into a mainstream staple. Sales are declining, not just in the highly visible U.S. retail segment, but across all channels, though international food service has shown occasional spikes, often tied to specific limited-time promotions with large quick-service partners. Operationally, the company has been burning through cash to maintain its infrastructure and to fund the costly process of continuous product reformulation, such as reducing sodium content and improving texture, in an effort to address consumer feedback and differentiate itself in a niche that has quickly become crowded with lower-priced alternatives, including those from traditional meat processors. The expectation was high margin growth and rapid market takeover. The reality is a challenging margin profile and market stagnation. The company's recent actions are an acknowledgement of the harsh reality, moving away from aggressive growth expectations toward a focus on operational efficiency. The Q3 2024 results, reported in November of 2024, actually showed a return to year-over-year revenue growth at 7.6%, a significant positive departure from the previous consistent declines, even if the absolute number was still relatively small at $81.0 million. More critically, they drastically expanded their gross margin to 17.7% from a negative 9.6% in the year-ago period, and slashed their operating loss from $79.6 million to $30.9 million. These are not signs of a game changer yet, but they are tangible evidence of management executing on a promise to improve cost structure. They are targeting a run-rate EBITDA positive operation by the end of 2026, which is an aggressive goal tied to further cost reduction measures and workforce streamlining. For investors trying to navigate the waters of this stock through their individual brokerage accounts, the question is whether the potential for operational improvement is strong enough to counter the clear trend of falling consumer demand. The recent announcement to address their convertible debt, involving a share swap that could potentially issue hundreds of millions of new shares, is a massive dilution risk for existing shareholders, which is a critical reality check against any short squeeze optimism. This is a critical factor for anyone using a platform like Fidelity or Interactive Brokers for long-term investment planning. High dilution can negate much of the upside, even in a turnaround scenario. Looking ahead, the future outlook for Beyond Meat depends almost entirely on two things: successfully achieving its aggressive cost targets and reviving consumer interest in the plant-based protein category. The near-term catalysts center around the upcoming delayed Q3 2025 earnings release and subsequent conference call. The market will be scrutinizing the details of the non-cash impairment charge that caused the delay, but more importantly, looking for clear, credible proof that the Q3 2024 trend of margin improvement and reduced operating expenses is sustainable. If management can paint a convincing picture of continued operational discipline and a path toward cash flow break-even, it could provide a genuine fundamental floor for the stock, separating it from the purely speculative forces that currently govern its price. The core opportunity for Beyond Meat, even in a contracting market, lies in product innovation that truly solves the taste and texture problems while simultaneously achieving price parity with traditional meat. Their collaboration on a new burger product with Stanford University School of Medicine focused on health is a step in the right direction, attempting to reclaim the health halo that has faded in recent years due to concerns about processing and ingredient lists. Should they secure a major, sustained partnership, a true anchor tenant deal in the food service sector, it could provide the volume needed to leverage their cost-cutting, thereby exceeding the current low expectations. The risks, however, are substantial and must be weighed heavily by any investor considering this stock through their self-investing platform. First is the continued erosion of market share due to competition and shifting consumer preferences. Second is the execution risk associated with their cost-cutting plan. Missing the EBITDA positive target could lead to a severe re-rating of the stock. And third, and most immediate, is the dilution from the debt restructuring, which acts as a ceiling on any fundamental price appreciation. The difference between the current expectation that the stock is a volatile trade and the potential reality that the cost-cutting measures fundamentally stabilize the business is the core tension. For the short-term trader, the recent volume and price action is the signal. For the long-term investment mindset, the story remains highly cautious. The key to navigating this stock, whether you are utilizing Schwab Intelligent Portfolios for diversified exposure or directly trading on a platform like Interactive Brokers, is recognizing which narrative is currently driving the price. At this moment, it's volatility and technical short covering. Comment below and tell me what price you believe the Beyond Meat stock will settle at after its Q3 earnings are released and the short squeeze volatility settles down. Are you expecting a floor near the lows or a sustained move toward a higher single-digit price? In summary, the recent 16.81% spike in the Beyond Meat stock price is a masterclass in market mechanics overriding fundamentals, driven by speculative pressure on a heavily shorted, low-priced stock. The expectation of a continued spiral down has been brutally challenged by a technical bounce, but the underlying reality of revenue decline, cash burn, and looming dilution remains the primary issue. Management is trying to fix the cost structure, which is the only real tangible positive